Today we're going to be talking about cash and stock dividends. When a corporation makes a profit, there are two things they can do with the money. They can reinvest the money back into the company, which is called retained earnings, or they can make payments to the shareholders of the company in the form of dividends. The board of directors decides if a company will pay dividends. Some companies like Amazon have never paid a dividend. There are three important dates related to cash dividends. First, the date of declaration. This is the date when the board of directors decides that they will pay a dividend and how large it will be. Second, the date of record is some date after the date of declaration. Anyone who owns shares of the company on this date will receive a dividend. Third, the date of payment is the date when the corporation makes the dividend payment. An important note about journal entries is that there is only a journal entry on the date of declaration and date of payment, but no journal entry is required as of the date of record. In addition to cash dividends, a corporation can also issue stock dividends. A stock dividend is when a corporation gives its current stockholders more shares of stock without any payment in return. Stock dividends decrease the market price of each share of stock, making them more affordable to investors. The accounting for stock dividends changes based on the size of the stock dividend due to assumptions about how likely the market price is to adjust. A small stock dividend is a distribution of 25% or less of the previously outstanding shares. For accounting purposes, small stock dividends capitalize retained earnings by the market value of the stock. The assumption is that for a small stock dividend, the market value of the stock won't change by too much, which is why it's used in the journal entry. The key words to link together in your brain here are small stock dividend and market value. Think SM, the first two letters of the word small, and the word market. Small market, small market. Say it with me, small market. You've got it. This chant will make more sense when we do the journal entry later in this video. A large stock dividend is a distribution of more than 25% of the previously outstanding shares. Large stock dividends capitalize retained earnings by the par value of the stock. The assumption is that for a large stock dividend, the market value will be unreliable as it's likely to decrease soon after the stock dividend due to the large increases in shares. The key words to link together here are large stock dividend and par value. I don't have a mnemonic or any other key tricks to help you remember this one. So I guess we'll just have to say it a few times together. Large par, large par. Come on, say it with me. Large par. Woohoo! The last thing to discuss is the stock split. Stock splits are similar to stock dividends. For example, a 2-for-1 stock split would mean that for every one share, the owner would have 2 shares after the stock split. There are no journal entries related to stock splits, although the par value of the stock is reduced, unlike in a stock dividend. In our example, a 2-for-1 stock split, a $10 par value would need to be cut in half, now down to $5 per share. So now let's get into some of the journal entries related to these dividends. So this question says that at the beginning of the year, a company began with 2,000 authorized shares of common stock, $5 par value, with 1,000 shares issued and outstanding. The first journal entry that we have to complete says that on January 9th, the board of directors declared a 20-cent cash dividend per share to the shareholders of record on January 19th. So this journal entry is for the date of declaration that we talked about earlier. Now remember that we said that a corporation's income could go to two places, either to retained earnings or to dividends. For accounting purposes, net income all gets put into retained earnings as part of the closing process. So in this journal entry, we have to decrease the retained earnings by the amount of the dividend. So that clues us in that we need to debit retained earnings to decrease it by the amount of the dividend. So let's put our date in here, which is January 9th, and then we can debit our retained earnings. Next, we need to figure out the amount of the dividend. The dividend is for 20 cents per share, but we have two different share amounts, the authorized shares and the issued and outstanding shares. Now, authorized shares can usually be ignored for purposes of journal entries, as they simply represent the maximum number of shares that a corporation can legally issue. We need the outstanding shares, which is the number of shares held by the public. The difference between outstanding and issued shares will be discussed in the treasury stock video. To find the amount of the dividend, we take the number of outstanding shares, 1,000 in this case, and multiply by the cash dividend per share, which is 20 cents. When we multiply those two numbers together, we get $200. So that's going to be our debit to retained earnings. Now the credit that goes along with this debit is going to be common dividend payable, which is a liability account that represents the dividend owed to the shareholders. And that's also going to be for $200. Next, on February 5th, the cash dividend declared on January 9th was paid to the shareholders of record. So this is the date of payment that we talked about earlier. Notice the date of record, January 19th, has no associated journal entry. So here, let's put in the date, February 5, and this is going to be a reversal of the payable that we used here, right? So we had the payable as of this date, and now we're going to be paying it off. So we need to debit common dividend payable for $200, and we are paying it off with cash, so we are going to credit the cash account to decrease that, and that's also going to be for $200. Next, on February 24th, we have a 30% stock dividend which was declared. The market value per share was $17 on this date. Since the stock dividend is for greater than 25% of outstanding shares, it is considered a large stock dividend. Remember our chant from earlier? Large par, large par. Well, that comes in handy here. This reminds us that the large stock dividend needs to capitalize retained earnings by the par value of the stock, meaning that the $17 per share market value here is irrelevant. So there are a few steps we need to take now. First, we need to determine how many shares the stock dividend is for. And to do that, we take the 30% stock dividend, or 0.3, and multiply by the number of shares outstanding, 1,000. So 0.3 times 1,000 equals 300. Next, we take the 300 shares that we just calculated and multiply by the par value, not the market value. So 300 shares times the par value of $5 per share is $1,500. So we need to capitalize our retained earnings by $1,500. And we should also put the date here, February 24. Now the other account that goes with this is common stock dividend distributable, and that is also for $1,500. Common stock dividend distributable is an equity account that only exists between the date of declaration and the date of issuance. In a way, this account serves as a placeholder for the common stock account until the shares are issued. Next, on March 17th, the stock dividend declared on February 24th was distributed. So basically, we just need to close out this common stock dividend distributable account. So we had to credit it in the last journal entry, and now we will have to debit it. So we debit common stock dividend distributable for $1,500, and that goes to common stock $5 par value, also for $1,500. Next, on August 29th, a 10% stock dividend was declared. The market value per share was $20. Since the stock dividend is for less than or equal to 25% of outstanding shares, it is a small stock dividend. Remember our chant from earlier? Small market, small market. Well, that comes in handy here. This reminds us that the small stock dividend needs to capitalize retained earnings by the market value of the stock. But first, we need to calculate how many new shares were issued. To do that, we take the percent stock dividend, which is 10% or 0.1 in this case, and multiply by the number of outstanding shares. But warning, we have more than 1,000 outstanding shares now. We started with 1,000 outstanding shares, but we added 300 when we had the large stock dividend. So the new number of shares is 1,000 plus 300 equals 1,300. So 0.1 times 1,300 equals 130 shares. Next, we take the 130 shares that we just calculated and multiply by the market value instead of the par value, since this is a small stock dividend. So that's 130 times $20 equals $2,600. So we're going to debit our retained earnings for $2,600. Let's put our date in here. Now next we need to have common stock dividend distributable, just like we had with the large stock dividend. But the key here is not to put the entire amount of $2,600 as the credit here. The common stock dividend distributable is going to be related to the common stock account that we're going to use later in the next journal entry, and therefore it has to be only the amount that's at the par value. Now remember, the par value was for $5. So all we have to do is take the 130 shares that we calculated in the last step, and then multiply that by the $5 par value to get the amount for the credit here. So 130 times 5 gives us $650. Now for the leftover part, just like when we're issuing shares of common stock, we're going to have paid in capital in excess of par value common stock. And that's going to be for the difference here. So 2,600 minus 650 gives us $1,950 to balance the journal entry. All right, last journal entry. On September 6th, the stock dividend declared on August 29th was distributed. So this is very similar to in the large stock dividend case. We just need to look back at this previous journal entry and find the common stock dividend distributable account. And that needs to be closed out. So we're going to debit common stock dividend distributable for $650. And the credit is going to go to common stock $5 par value because now it has been issued as common stock. Alright, we are finished with the journal entries. The last thing I want to talk about is the effect of cash and stock dividends on the balance sheet. So if we look at the small stock dividend, we can kind of ignore the common stock dividend distributable account because that just kind of gets closed out. The only accounts that are really important here are retained earnings, paid in capital, and common stock. So this is really just a transfer from retained earnings, which is getting decreased, to the paid in capital and common stock accounts. And all of those accounts are equity accounts, so there's really no change here in equity. And that's the same case for the large stock dividend, except for we don't have that paid in capital account. It's just a transfer from retained earnings into common stock. Now we have a little bit different of a case with the cash dividend. So we have a debit to retained earnings for $200 and we have a credit to cash for $200. We can ignore the common dividend payable because those two amounts cancel each other out. So we have a decrease in equity by $200 and we have a decrease in assets for $200. So that's different than the stock dividend where we really had no change in the makeup of the balance sheet. In here we have a decrease in both assets and equity. So my key point is that cash dividends decrease assets and equity through cash and retained earnings, whereas stock dividends shift equity between a few different accounts, notably from retained earnings to common stock. Alright, that wraps up everything I wanted to talk about in this video related to cash and stock dividends.